It's not what you buy, but what you pay. Sounds simple, almost obvious, right? But that tiny sentence is the invisible line separating amateur investors from the pros. Because picking a good company for your portfolio isn't the same as making a good investment. You can buy a masterpiece, but lose your shirt if you overpay. Hey Money Explorers, welcome back to Money Made Easy. After years of navigating the financial markets, one thing has become crystal clear. Success isn't just about the quality of a company, it's about the price you're willing to pay. Every investment should be a careful balance of excellence and value. Think of it. You don't want an amazing company at an insane price, but you also don't want a dumpster fire just because it's trading for pennies. It's about finding that sweet spot, and this balancing act isn't just about numbers. It's deeply emotional. Investing is a human endeavor, and emotions are often our worst enemy. Today, we're diving into a seemingly counterintuitive idea. To be a truly successful investor, one who aims for above-average returns, you need to learn to invest below average. Stick with me, and by the end of this video, you'll understand the profound meaning of this statement and how discipline and the ability to stomach discomfort are crucial for long-term investing success. We also explore the importance of recognizing economic cycles and how they ebb and flow in a perpetual, necessary rhythm. Let us start with a fundamental truth. The masses tend to buy when everything looks rosy and sell when the sky is falling. And the paradox is that this very collective behavior creates market movements. The crowd buys, prices go up. The crowd sells, prices crash. The reality is, you'll never make consistently good investment decisions if you can't handle a little pain. You need to be a bit of an outlier. Yes, that means stepping outside your comfort zone. The most crucial decision you'll make for your medium to long-term investments is which stock or ETF to buy, or which hot sector to bet on. The real question is, today, should I be more aggressive or more defensive? Because if you misjudge the overall risk level of your portfolio, all those individual stock picks matter a whole lot less. Following the herd feels safe, but the herd is often wrong. All the legendary investors, they don't follow the crowd. They buy when everyone else is selling, sell when everyone else is buying, avoid what everyone loves, and buy what everyone hates. But it's not easy. It takes the courage to go against the prevailing sentiment. That's where discipline comes in. To beat the market, you need to be different. And to be different, you need to be prepared to feel uncomfortable. Think back to early 2025, when the market got rattled by the announcement of new trade policies. It was a sharp shock that sent global markets into a spin. Just days, the US stock market lost trillions in value. The S&P 500, the NASDAQ, the dollar, oil, all down. We were back in negative territory. The atmosphere felt eerily similar to some of the darkest moments in financial history. The crash of 29 Black Monday in '87, the dot-com bubble burst, the 2008 financial crisis, the COVID crash of 2020. Each time, the beginning felt like just a minor correction. It's a movie we've seen before, playing out again. And if history teaches us anything, it's that market cycles aren't a threat, they're a map. If you learn to read them, they can guide you through the storm and straight towards the next opportunity for profit. Howard Marks, one of the most respected investors globally, explained this in his book Mastering the Market Cycle. Most people make the wrong decisions at the worst times. They become greedy when things are going too well and terrified the moment the euphoria ends. The cycle repeats. Growth, euphoria, excess, crash, fear, return to the mean, and it starts all over. It's a dance, a spiral, a perpetual cycle, and each phase feeds on the previous one. The rise creates excess, excess creates the crash creates fear, and fear creates opportunity. We saw it in 2000 with the internet bubble, in 2008 with subprime mortgages, 2020 with COVID, and we're seeing it again. The fear and greed index often shows extreme fear during these downturns, and Howard Marks reminds us that it's precisely in these moments that true long-term returns are built. The key is understanding where we are in the cycle and adjusting our risk profile accordingly. Aggressive or conservative? After a period of seemingly endless gains, like we saw in 2023 to 2024, There were investors throwing money at anything that sounded exciting, like artificial intelligence, even when company valuations were insane. When the price-to-earnings ratios screamed risk, but enthusiasm was blind. Fundamentals didn't matter. Everything's going up. That was the mantra. Between 2022 and 2024, the total market capitalization of the S&P 500 jumped from $30 trillion to $54 trillion, in addition of $24 trillion. And guess how long it took the market to add that same amount between 1995 and 2022? 28 years. Then, in just a few weeks in 2025, it lost over $5 trillion. Now that the music has stopped, many just want out, want to recover their losses, want to stop the bleeding. The VIX, the so-called fear index, spiked 2 levels seen only twice since 1990, during the COVID pandemic and the 2008 financial crisis. When the VIX is above 30, like it is right now, the market can move by 3 to 5% in a single day. To put it mildly, that's 10 times more volatile than normal. In these situations, if you lack experience, the market will chew you up and spit you out. But there's something you can do. You can use volatility to your advantage to build long-term investments. I'm talking 10, 15, 20 years and beyond. And this is where a cool head is essential. This is where those who understand the economic cycle can make a real difference. When everyone is running for the exits, when confidence is at its lowest, when fear dominates, perceived risk is sky high, but real risk, that's often already priced into the market. If prices are low enough to reflect all the panic in the world, then the risk is minimal and the potential return is maximal. Warren Buffett said it best. Be fearful when others are greedy, and greedy when others are fearful, because most people do the exact opposite. When everything is going up, they lower their defenses, take on too much risk, accept lower. And lower risk premiums stop analyzing and don't protect themselves. Then when the correction hits, those same people just want to get out, even at a loss. This behavior has repeated itself for a century. People don't learn from their mistakes because they don't recognize the cyclical nature of the market. But if you understand that each phase is just a transition, then you can act rationally when everyone else is irrational. And this is where a fundamental concept comes in: valuation. In the long run, the only thing that truly matters is the price you pay to get in. Today, the S&P 500's price-to-earnings ratio has dropped from around 29 times to about 26 times. In other words, the market is now roughly 10% more attractive, or on sale, compared to a few months ago. So, where are we in the economic cycle right now? Well, we're likely near a bottom in the consolidation phase. Sure, we might still see some downward movement, but we're in that gray area where prices start to reflect perceived fear more than reality. And this is where the real investment choices are made. Not when everything is rosy, but when nobody wants to touch the market with a 10-foot pole. As the great investor Howard Marks says, the riskiest phase isn't when everyone is scared, but when everyone thinks risk doesn't exist, and vice versa. The safest phase is often precisely when risk feels omnipresent. This is the moment when smart investors start to move quietly, methodically, cautiously, following a precise process. And make no mistake, I'm not saying the market can't go lower. Of course it can, especially with all the crazy headlines, geopolitical issues, tariffs, layoffs, and wars. But in the long run, history is crystal clear. The lower your purchase price, the higher your expected future return. So, am I saying you shouldn't be scared? No, absolutely not. Being scared is normal, but that shouldn't stop an investor from applying their process. The key isn't to be fearless, it's to act despite the fear. If you're not scared in certain phases, well then you're probably crazy or not human. But that's where the difference lies. Feeling the fear, but investing anyway, and following your process. Because we all read the same news, listen to the same commentators, and breathe the same market atmosphere. Yet only those who have the courage to detach themselves from the crowd, to think divergently, can truly outperform. In conclusion, everyone wants to be a great investor, wants to multiply their savings, but few truly want to be different. And if you want to be above average, you have to be willing to be below average at times. Because every choice outside the herd involves risk. Overweighting a stock, avoiding another, betting on a country or a sector, every action that can lead to above-average returns can also lead to being below average. And you have to accept that. But if today you're willing to be different, to feel uncomfortable, to buy when no one else wants to, then you're doing the right thing. If you've done your homework, understand the sector, and know what you're doing. If you can act with discipline when the world is screaming panic, then you're on the right track. And if you truly want to be an above-average investor, you also have to be prepared to make mistakes. But you must have the courage to try anyway. Accept the error, learn from it, and not repeat it in the future. There are no shortcuts in the financial world, no certainties in the world of investing. There is only the knowledge that gives you the courage to do what's right when everything tells you to do the opposite, because there's no greatness without risk, and no return without resilience. That's it for this video. Thank you for sticking around until the end. Leave me a comment below and let me know how you're re-navigating this particular period in the economic world and financial markets. Subscribe to the channel if you haven't already. We'll see each other very soon. Happy investing to all. Ciao.